All right, folks, this week we got a slew of corporate earnings, mostly from banks, but many other consumer-related companies also reported earnings. We're going to talk about two of them, JPMorgan and Delta Airlines. Why? Because we have different stories here, conflicting stories, it appears so. One story from JPMorgan CEO Dimon, who's the head of the Landromat, also known as JPMorgan, and we call it that because they got caught washing money for mobsters, criminals, oligarchs, and terrorists, and many others. And this will become relevant, by the way, when we talk about JPMorgan's earnings. But I like to bring up the fact that the US government called JPMorgan's commodities desk a crime ring. But anyhow, JPMorgan Chase CEO Jamie Dimon, who's usually the optimist in the room and usually upbeat about the economy, this time around in the earnings call, he issued multiple warnings and sounded as a pessimist when it comes to this economy, bringing up the R word, the recession word, over and over and over again. On the other hand, we got earnings from Delta Airlines, and the story from the CEO could not be any different from JPMorgan Chase. Delta CEO said this was the hottest quarter ever for Delta. The consumer is strong, and they're spending. So which CEO is telling the truth about this economy? We will discuss in details throughout this program. Let's dive right into it. Here it is, in focus tonight. The tale of two earnings. Is the economy about to head into a recession? Is the economy about to free fall? Or is the economy hot, that it will be able to withstand anything you throw at it right now? Which CEO is telling the truth? Is it Jamie Dimon? Or is it Baston from Delta Airlines? Or perhaps both? Let's hear what these two gentlemen said about their company's earnings.
You've got two other very large countervailing factors, which you guys are all completely aware of. One is inflation / QT. You've never seen that before. I'm simply pointing out that those are storm clouds on the horizon that may disappear, they may not. That's a fact, and I'm quite conscious of that fact, and I do expect that alone will create volatility and concerns and endless printing and endless headlines and stuff like that. And the second is war in Ukraine. I pointed out in my letter that, war in Ukraine, usually wars don't necessarily affect the global economy in the short run, but there are exceptions to that. This may very well be one of them. I'm not looking at this on a static basis, okay? So you're looking at this war in Ukraine and, if sanctions stay where they are, things are unpredictable. Wars are unpredictable. Wars have unpredictable outcomes. You've already seen in oil markets, the oil markets are precarious. Okay, so I pointed that out over and over, that if people don't understand that those things can change dramatically for either physical reasons, cyber reasons, or just supply demand. And so that's another huge cloud on the horizon. And we're prepared for it. We understand it. I can't tell you the outcome of it. I hope those things all disappear and go away. We have a soft landing and the war is resolved. Okay, I just wouldn't bet on all that.
Well, the demand is phenomenal. We've never seen in our company's history demand for our product and services at the level we are. In the month of March, we had the highest sales in terms of bookings of any month in our history, period.
Highest ever.
Highest ever.
So again, according to Jamie Dimon, a lot of things have to go right for this economy to withstand and avert a recession, and he said he wouldn't bet on it. On the other hand, you have Delta CEO saying, wait a minute here, we're having the best quarter ever. The economy's hot, but there's something important you have to pay attention to. Delta CEO did not say our bookings are the best ever. This is the best quarter ever when we talk about the number of bookings. He said sales of bookings, and this is extremely important, so keep that in mind because we will revisit this by the end of the video. But let's backtrack a little bit. These are the earnings, at least some of them, that we got last week. We got CarMax, we got Albertsons, we got Delta, JPMorgan, BlackRock, Goldman Sachs, and many other banks. We talked about CarMax in details in a previous episode, but it is important to view it from the consumer perspective because a lot of analysts out there came out and said The CarMax's earnings stand as a proof that we're seeing demand destruction in the economy. I disagree. I believe what we saw in CarMax earnings is the fact that the company ran out of inventory. Their competitive advantage is gone now. They used to have an inventory that they bought cheap, and after inflation hit, they sold these vehicles at a massive upmark. So the margins improved dramatically for CarMax. The problem is, once you run out of this inventory, you gotta buy new inventory at the inflation prices, at these insane prices, to replenish the inventory. And now your margins are gonna shrink. Your competitive advantage as a company is gone. Furthermore, and this will be relevant to the discussion we're about to have of JPMorgan versus Delta. And by the way, this is a finding that the majority of the media decided to ignore. The majority of the analyst community decided to ignore. And here it is from Bloomberg. Look at this. It says, in the subtitle, it says, more buyers seeking vehicle loans longer than 72 months. Why is this problematic? It tells you that the consumer is looking to buy these cars. There is no demand destruction, but they're getting squeezed when it comes to their budgets. Inflation is killing their budgets, so they're looking for loans more than 72 months. Once again, there is no demand destruction for now, and hence, used cars prices will climb higher again. So we don't have any peak inflation in this economy right now. The problem that we're having is the consumer is getting weaker, and I'm going to prove it to you in a minute. But this is one sign, a telltale sign. Furthermore, we got earnings from Albertsons. In Albertsons, the earnings were pristine, in my opinion. The problem is, looking ahead, Albertsons issued a warning that the consumer facing this inflation is having to choose between which items to buy, and they're reducing their spending to be limited to essentials. Why? Because the inflation at the pump, these gas prices, are killing the spending power of the consumer. We also got earnings from a miner, gold miner, Barrick Gold, and even this miner with an enormous competitive advantage, because you'd think that these miners, these gold miners, will benefit from inflation moving higher. But at some point, inflation gets really bad that it bites the competitive advantage of even inflationary companies like gold miners. And we saw this name taking a leg down. The stock went down after reporting. When it comes to banks, the story becomes really alarming. Look at Citibank, for example. The profits were down 46%. So what's going on here? I told you in this channel before that these sanctions and the boycotts against Russia will have severe economic impact on the West. US companies, European companies, all the participants in the sanctions will also get hit. It's not just Russian banks and Russian companies. Look, for example, at Deutsche Bank over Germany. Along with Commerzbank, we've seen these two stocks dropping significantly on a mystery $1.9 billion sale. So what's going on here? We remain confident in our strategy as laid out during our investor deep dive in March. A spokesperson for Deutsche Bank said, as we said during our investor day, we have had a promising start into the year and our objectives remain unchanged. Don't look here, nothing is going on behind me. The building that is on fire, that's just your imagination. Here's the other one. The sale of a shareholding does not change anything about our strategy, or you think? A spokesman or spokesperson for Commerzbank said, the business model and risk management of the bank have proven themselves in challenging times. We have yet to get into the challenging times, buddy. And we now know why they're dumping the shares of these banks. They're building an insane amount of reserves to make up for the fallout from these Russian sanctions and perhaps the default of Russian assets. We're going to talk about that in details because the largest bank in this country, JPMorgan Chase, made a stunning move last quarter, and it's a telltale for what's about to come in this economy. But before I do that, I'd like to visit Delta's earnings and talk about that first. Because here it is, the headline from the New York Times says, despite a record loss in the first 3 months of the year, as thriving ticket sales were offset by high fuel prices, Delta said its March operation were profitable and that it had been able to pass some of the higher cost of fuel along to customers. And let's hear what the CEO said in his own words. And this is very important, so take a listen.
You have raised your fares, as have all of your competitors, dramatically. As demand has returned, you've got to offset what you're seeing with jet fuel. Have you been a little bit surprised at how much you've been able to raise them? Not that you're trying to get more from the consumer, but you've raised them dramatically, yet the demand is still there. You haven't seen the pushback of people saying, whoa, too far?
Well, they've been raised dramatically as compared to last year, or maybe even the year before. But those were periods when the pandemic was really depressing airfares and we didn't have traffic. So it's really not fair to compare it to the last 2 years. You really have to go back to 2019. And yes, fares are up relative to 2019, but not necessarily as dramatic as the just 1 year indications suggest.
Now, the CEO can sugarcoat it all he wants, but there is a significant problem here. The earnings, the numbers don't lie. The only advantage for Delta Airlines was the ability to pass the inflation cost all the way down to the consumer who's willing to fly, perhaps because they have to or they want to. We have no clue at all, but what we know for sure is they're paying a massive premium for these tickets. Look at these earnings, by the way. The passenger revenue for Delta Airlines, when you compare it to 2019, because we cannot compare it to 2020 or 2021, these were amidst the lockdowns, and it's just not going to give you a good look of what's going on in this company. But when we do 2022 versus 2019, the passenger revenue is still down 25%. We talk about expenses, salaries, and related costs, and this is perhaps the reason why the stock blasted higher after reporting. Salaries and related costs were up only 3%. Aircraft fuel and related taxes were up only 6%. And this is when we compare 2022 versus 2019. If we do 2022 versus 2021, the numbers will be astonishing. When we talk about passenger commissions and other selling expenses, they were down 34%. This is highly important, because the company is cutting down their spending. They're not spending more on advertising. They're not spending more to attract passengers to fly. The passengers are coming on their own will, and they're paying the premium for these tickets. When we talk about the net income for the company, it was a loss of $940 million. When we talk about the ticket revenue, the main cabin, when you compare it with 2019, the CEO says this is the best quarter ever. Not really, because the revenues were down 26% from 2019. All in all, the total passenger revenue was down 25% from 2019. When we talk about the domestic versus Atlantic and Latin America, Pacific, all of these regions, they're all down. Significantly so. The most important segment is domestic. This was down 17% from 2019, and all in all, the revenue was down by about 21%. So again, when we talk about Delta Airlines earnings, it's bad. It's not good, because we're not seeing this comeback of travel that everybody anticipated. The numbers are way behind 2019 numbers. But the good news is the company is able to pass a lot of the inflation cost down to the consumers who are flying right now. And we're seeing these consumers paying more and more for these tickets. So when the CEO says we're seeing the best quarter of sales of bookings, he's not lying. He's saying the truth. The sales are high because the consumer is paying more. But that doesn't mean that more consumers are flying. It means that the consumers who are flying, well, they're paying more. And this is important for the company because it keeps it afloat for now. How long will they be able to pass the inflation cost all the way down to the consumer? Well, the answer to that is the core of this video. And I'm going to explain all of that to you by the end. But before we do that, let's go and shift to visit JPMorgan's earnings. Look at the contrast. Delta CEO says the best quarter ever. On the other hand, JPMorgan CEO says he actually sounds a warning and says the U.S. economic recovery could backslide. Jamie Dimon said that there are powerful forces, quote unquote, that could threaten the U.S. economy. Furthermore, JPMorgan earnings went down by 42%. This is a stunning number, folks. But why? The nation's biggest bank recorded a profit of $8.28 billion in the first quarter, a 42% decline from a year ago. Revenue fell 5% to $30.72 billion, ahead of analysts' expectations for $30.59 billion. Here's the problem for JP Morgan. Look at the net revenue. This is for the entire bank, by the way. Quarter over quarter, the revenue was actually up 5%, but year over year, the revenue was down 5%. The problem with JP Morgan and the rest of banks, by the way, is not the revenue. The problem is earnings, the bottom line. The net income quarter over quarter went down by 20%. Year over year, the net income was down 42%. Stunning number. Why? Because they moved about $1.5 billion into the provision for credit losses, meaning JP Morgan is now anticipating perhaps a lot of defaults, and they're moving about $1.5 billion off reserves to compensate in case these defaults happen. Now, when the largest bank in the country does a move like this of moving $1.5 billion in a single quarter as provision for credit losses, they're not being upbeat about the economy. They're seeing something alarming in the future, and they're being prepared for that outcome. Here's from the Wall Street Journal. The bank took total credit charges of $1.5 billion off the $900 million set aside for potential future losses. About 1/3 was tied to Russia. Da-da-da. Chief Financial Officer Jeremy Barnum said, the rest, he said, is to account for the risk that interest rate increases by the Fed could cause the economy to slow too much, resulting in a recession. Once again, da-da-da-da. What about another segment in JPMorgan's Chase earnings? How about consumer and community banking? Because this is important, right? When we talk about the health of the economy and the health of the consumer, we want to see if the consumer is borrowing more. Are they paying down their debt? What is the net charge-off rate, which accounts for balances that are at the risk of defaulting, for example? We'll look at the net revenue for this unit. It was down 2% year over year. But look at this. When we talk about consumer banking, it was actually up 8% year over year. But here's the problem. Home lending was down 20% year over year. This is an ominous sign for what? The housing market. We're seeing a slowdown in the housing market. They're not taking more loans, more mortgage loans. And that could be due to the lack of inventory, perhaps inflation gone too far, or maybe the most alarming explanation is the consumer cannot afford to take these loans at this time. They have inflation to face. They have utility bills skyrocketing. They have rents skyrocketing. They're having groceries skyrocketing. They're having gas prices skyrocketing. So it's not a time to take a home loan. When we talk about card and auto loans, they were down 8% year over year. All in all, the net income for the consumer and community banking unit was down 30% quarter over quarter and down a stunning 57% year over year. The majority of that decline came from the home lending part. But this is really important. From the Wall Street Journal, once again, pay attention now, because we will tie up Delta Airlines comments along with JPMorgan's comments, and you will realize that nobody's lying here. They're telling the same story from different angles. Consumer spending on credit cards rose 29%. With a 64% increase in spending on travel and entertainment. Da-da-da-da. So now you know, when Delta CEO says the consumer is hot, and we're seeing the best quarter ever in terms of sales, they're not having any trouble at all passing the inflation cost all the way down to the consumer. Now you know why. Because the consumer is swiping those credit cards up and down, with no regard at all to what happens to the outstanding balance. Consumers started carrying more debt as well, as credit card loans increased 15%, though card loans remain below pre-pandemic levels. The increase potentially signals that some consumers have started to burn through stimulus funds. Are you paying attention or not? That buffered them throughout the pandemic. This is an important transition from the stimmies and the free yayo to the actual money that the consumer has, or perhaps doesn't have. And if they don't, they're going to have to swipe those credit cards up and down, racking all of that debt to combat inflation. The question is, what happens to those people and their outstanding debt when they lose their jobs, if the economy is indeed heading into a recession? It's a problem nobody wants to talk about. Anyhow, back to JPMorgan Chase. What about the corporate and investment bank unit? Well, the net revenue was up 17% quarter over quarter, yet it was down 7% year over year. The markets and securities services, this is important, was up a stunning 48% quarter over quarter, and this is an illustration for you about the importance of market volatility to these banks' earnings, in this case, JPMorgan Chase. Oh, they love market volatility. So when we talk about mysterious pumps and dumps in the stock market, you might want to put two and two together here. Yet the year-over-year revenue for this unit was down 8%. All in all, the net income was down 3% quarter-over-quarter and down 26% year-over-year. And here are some important details for this unit. A sharp decline in the volume of IPOs helped push revenue down 7% and profits down 26% in JPMorgan's corporate and investment bank. The unit also took $524 million in losses related to the bank's commodities and Russia exposure. including $120 million in trading losses tied to nickel. Remember that story? JPMorgan is a top margin lender to Chinese metal giant Tsingshan Holding, whose giant short position on nickel plunged when the price of the metal surged after Russia invaded Ukraine. What about the commercial banking unit? The net revenue quarter over quarter was down 8%. It was pretty much the same year over year. Yet once again, when we talk about the provision of credit losses, this is really denting the net income for the company. The net income quarter over quarter was down 31%. Year over year, it was down 28%. And here's the problem. The total investment banking fees fell 31%. Equity underwriting sank 76% to its worst quarter in 6 years. Listen to this. Trading revenue fell 3% from a year earlier when corporate debt sales, IPOs, and the army of individual investors powered the stock market boom. So the stock market boom was good for JPMorgan Chase, Goldman Sachs, and the rest of them, but it was just a pump and dump scheme for the public. The geniuses, chasing meme stocks and garbage stocks and tulips and the likes. Fixed income trading was down 1% and equities trading fell 7%. Markets will get even choppier in the coming months as the Fed moves to tame inflation, Mr. Diamond said. The central bank raised interest rates last month for the first time since 2018, and it is expected to continue to raise rates throughout the year. Now, what about one of the most stable units in JPMorgan Chase, the Asset and Wealth Management Unit? Well, the net revenue was down 4% quarter over quarter, yet it was up 6% year over year. The net income, all in all, was down 10% quarter over quarter and down a stunning 20% year over year. And lastly, when we talk about the corporate unit of JPMorgan Chase, look at this. This is tied to Russia, by the way. The net revenue was down a stunning 62% quarter over quarter and a shocking 86% year over year. All in all, the net income was down 32% quarter over quarter. So here is the reality, folks, when we talk about the tale of two earnings. Nobody's lying here. Both CEOs are telling the same story, but they're telling the story from two different perspectives. One concentrated on the present, the other is concentrated on the upcoming future. When we talk about the present right now, yes, the economy is still hot. The consumer is still flush with cash. We're not seeing job losses at all, at least not right now. And we have more data supporting the upbeat and perhaps lifting attitude of Delta's CEO. Look, for example, at consumer confidence, the reading that we got last week. Consumer sentiment improved dramatically in March. Likewise, when you talk about the index of consumer expectations, this was the largest advance since 2006. Likewise, we're seeing retail sales stable, still holding, the consumer is still spending, and their sentiment is improving dramatically, at least for now. But perhaps this explains why the consumer is upbeat about the economy and why the sentiment improved. And this is when we get to the problem of migrating from the la-la land of Delta Airlines to perhaps the reality presented by JPMorgan Chase. Look at consumer borrowing, for example. It reached a record high in February. The consumer racked up $42 billion in debt, the largest ever. So we're seeing the consumer swiping those credit cards up and down, up and down, up and down, with no regard of the consequences right now. How could their sentiment sink? Their sentiment is improving because, hey, I can buy whatever I want using the credit card, and I got a decent wage, my job is in the bag, and I can pay this credit card debt in the future. The problem is they are assuming that their jobs are in the bag. And look at this, when we talk about the consumer chasing inflation, it is evident from debit card spending. The 2022 debit card spending is way above the pre-pandemic debit card spending. That tells us for now that the consumer has some cash. They're using their debit card more often, but they're also using their credit cards more often and increasingly as of late. That tells us that the consumer for now says, to hell with inflation. We had about 2 years of being locked down, and I want to go out. I want to experience traveling. I want to go to a hotel, Airbnb. I want to go out to a restaurant and eat. So they're using those credit cards and they're spending more out of their savings too, regardless of inflation, at least for now. When you put two and two together and you look, for example, at the fourth quarter of this year, when the Fed starts to increase interest rates dramatically, the economy will slow down. We will see some job losses and the picture will change entirely. And this is what JPMorgan is looking at. They're not looking at the present as Delta, for example. They're looking at the fourth quarter of this year and beyond. And this is what JPMorgan Chase and Jamie Dimon are looking at. Look at inflation expectations, for example. The median 1 year ahead has climbed up in a stunning fashion. Why is this a problem? Well, you combine it with food inflation, for example. Food inflation is now surging significantly higher, and it is becoming the most important contributor. The CPI rising higher right after energy. When inflation continues to move higher, the consumer has to make difficult choices. Once the post-lockdown party is washed out, the consumer will have to realize that they have difficult decisions ahead, difficult financial decisions ahead, as inflation continues to move higher. For example, the percentage of people who cited price increases as a reason not to buy or do something, even when cost was not a factor. And we're not talking about the fourth quarter of this year, by the way. We're talking right now. So the warning signs are already here. Well, 14% said often, 19% said once or twice, 33% said sometimes. And here's the problem again, the priorities of spending. Well, we ask the consumer facing this inflation, what areas of the economy, what areas of consumption are you reducing spending on? 55% say eating out. So watch out here for all of these restaurants. They're going to go bust. 52% say impulse purchases, 33% say driving, 33% once again say concerts and sports. So watch out if you have, for example, Live Nation as a stock in your portfolio. Perhaps you want to book profit in that one. 31% said clothing, 22% said flights. So Delta CEO, watch out here. You're popping the champagne right now. It's not going to look good in the next few months when the consumer have to make these difficult choices. 22% are cutting down on alcohol spending. Thank God. 21%, perhaps there is a silver lining of this inflation. But anyways, 21% are cutting down on hotels spending. And where are Americans seeing the notable price increases? Where are they facing the inflation challenges the most? Well, the answer is 75% gas, 73% groceries, 38% eating out, 36% utilities, 27% clothes, 22% cars, 21% rent, 20% online orders, 22% for flights, 22% alcohol, and 21% hotels. Also, the role of psychology is critically important in this game. Not just inflation expectations, but also recession expectations, because it alters consumer behavior. In this case, look at Google Trends, for example. The searches for recession are skyrocketing now. So the consumer is expecting a recession, and as a result, they're going to change their behavior. They're going to spend less on things they deem unimportant or unnecessary, and this will hurt the economy dramatically. Economists' expectations are now surging. When we talk about the chances of the U.S. recession within the next 12 months, we're now talking about almost 20% saying that. And remember, Larry Summers said, give it a little more time, and the consensus among economists will be a recession. We also have ominous signs, and this is perhaps what Jamie Dimon and JPMorgan Chase are looking at, the inversion of the yield curve. Another reliable indicator that we have a recession ahead. When we talk about the probability of a recession in the next 12 months, the probability of being in a recession, those probabilities are still low for now, but they could move significantly higher. And if they do, we will see a lot of pain in the equities market, and we will see a lot of pain in the economy as a whole, because the consumer will become even more alert and alarmed about the upcoming recession. According to Bank of America Global Fund Manager Survey in the month of April, the question was, what do you consider the biggest tail risk for this economy? 26% said global recession at number one. At number two, 25%. A hawkish central bank, or banks, make that plural, 21% inflation. And these are all related, by the way. Inflation causes the hawkish Fed, which causes the recession. But here it is, Russia-Ukraine conflict, 16%, asset bubbles pop, 7%, and the thing at 1%. Nobody likes the thing anymore. It's like the ugly guy at the high school dance. Nobody wants him at all. And then, of course, he grows up and becomes a nerd and becomes a billionaire. And the girls call him back. Hey, remember me? No, bitch. I don't remember nothing at all. Anyways, when we talk about global growth optimism, it hit all-time lows. Yep, lower than 2008, lower than 2000. After the crash of the stock market, the dot-com bubble implosion. So this is really bad. The fund managers are extremely bearish on this economy. They see something here that is extremely alarming. One of them is perhaps this. Have you ever heard about the Dow theory? Well, this 100-year-old stock market indicator has tumbled into a bear market, sending a warning sign for this economy. The crash in transportation stocks is absolutely alarming, but this will be the subject of another video. For now, to conclude this video, the tale of two earnings. They're exactly the same. They're looking at the economy from two different angles. One looking at the present, Delta Airlines, and one looking further down in the future, and that is JPMorgan Chase. And if you didn't know, now you know. Folks, this is all I got for you for this video. Thank you for listening. Thank you for watching. And remember, I have another video, the technical analysis, coming out this evening. But if this is the last video you're going to watch from me tonight, then happy Easter and good night.